Join me as I challenge myself to find the easiest low-risk investment strategies for 2025 and see if I can actually make it work. Low-risk investing, it's a topic that's becoming increasingly relevant and accessible in 2025, and for good reason. With the market's volatility and unpredictability, it's more important than ever to have a solid foundation of investments that can provide stable returns without keeping you up at night. I've talked to many people who think that low-risk investing is, well, boring. They believe that it's only for retirees or those who are extremely risk-averse. But that's not entirely true. Low-risk investing can be a great way to build wealth over time, even if you're not ready to retire just yet. Another common misconception about low-risk investing is that it yields very low returns. While it's true that you might not get the same returns as you would with a high-risk investment, the trade-off is that your principal is much safer. And let's be real, who doesn't want to reduce their risk of loss? Some people think that low-risk investing means you have to sacrifice returns for safety. But that's not necessarily the case. There are many low-risk investments out there that can provide decent returns, even if they're not as high as what you might get with a riskier investment. When it comes to low-risk investments, there are several options available in 2025 that can provide a decent return without putting your principal at risk. Bonds, for example, are a type of debt security that can provide a steady stream of income with relatively low risk. Index funds are another option, which track a particular market index, such as the S&P 500, to provide broad diversification and reduce risk. And let's not forget about high-yield savings accounts, which can provide a higher interest rate than your traditional savings account. Bonds are a great option for those who want a low-risk investment that can provide a steady stream of income. They're essentially debt securities issued by companies or governments to raise capital. When you buy a bond, you're essentially lending money to the borrower, who promises to pay you back with interest. Index funds are another popular option for low-risk investors. They track a particular market index, such as the S&P 500, to provide broad diversification and reduce risk. This means that you're not putting all your eggs in one basket, so to speak, which can help reduce your risk of loss. High-yield savings accounts are also a great option for those who want a low-risk investment that can provide a higher interest rate than their traditional savings account. These accounts are typically FDIC insured, which means that your deposits are insured up to $250,000, making them a very low-risk option. But here's a surprising strategy that can help you maximize your low-risk investments: robo-advisors. These are online platforms that use algorithms to manage your investments, providing a diversified portfolio with minimal risk. The best part is that they're often much cheaper than traditional financial advisors, making them a great option for those who want to keep costs low. Robo-advisors use a combination of low-cost index funds and ETFs to provide a diversified portfolio that's tailored to your risk tolerance. This can be a great way to maximize your returns while minimizing your risk. Another advantage of robo-advisors is that they're often very hands-off, meaning that you don't have to spend hours researching and managing your investments. This can be a huge time saver for those who want to invest but don't have the time or expertise. So, there you have it, folks. Low-risk investing doesn't have to be boring or yield low returns. With the right strategy and tools, you can create a diversified portfolio that provides stable returns without putting your principal at risk. Thanks for watching, and if you have any thoughts on low-risk investing, please leave them in the comments below. And if you want to learn more about investment strategies, be sure to check out my other video on the topic.